Today, we're going to talk about real estate venture investing. What is real estate venture investing? Real estate venture investing is when we invest in higher growth, earlier stage operators, both in their projects and in the operator themselves to, scale their platform. So, we're going to combine multiple fee streams here to generate, in real estate, we're typically looking at, 1.5 to 2x multiples on our invested capital. Here, we're looking more like 4x to 10x. And most importantly, it comes with the downside protection of traditional real estate investing. So we're still investing in a hard asset. We're still protecting our downside, but we're also going to create a lot of upside in the way we structure the deal. So let's hop into, what this looks like, those three layers. So the first is high yielding LP returns. So still focused on, getting our traditional LP return out of a deal, but we're focused on higher yielding strategies. So oftentimes these are investing in assets that are sub-institutional, they're in more niche markets, or there's some operational complexity that's being layered on top by the operator to enhance the yield and ultimately the return to us, the investor, on the deal. So we're focused on, more higher yielding deals first. Then we're focused on also getting a piece, because we're investing in these, higher yielding, more niche deals. We're taking a piece of the GP economics as well. So call that typically 10 to 25% of the GP's economics. So those are their fees and promote that they're receiving. We're going to layer that on top of our LP returns. And then lastly, we're also going to take a piece of an operating company or the platform itself that will have some enterprise value in the future. So, if you have a multifamily operator, like we'll see in a second, who's building out their own operating brand to operate a building as a extended stay hotel or corporate housing, and they build a brand that can scale and have enterprise value on its own, those are the types of deals we're looking for, where we can take a small percentage of the operating company as well. And if that sells in the future off some EBITDA multiple, that's kind of the venture piece of this. So high yielding LP returns, then layer on the GP economics, then in the future layer on OpCo or platform equity returns to create a more higher yielding, more exciting real estate investment. And so, again, our total multiple on invested capital we're targeting is 4 to 10x, but again, with downside protection. So we're going to have the downside protection of the real asset. So unlike in venture, our investment is almost never going to go to zero. So what does this formula look like? First, we have to target those high yielding strategies, things that are sub-institutional, they're fragmented, and oftentimes it's very ops heavy. There's some operating component that sits on top of the real estate itself. So this can look like next generation campground models. It can look like marinas. It can look like student housing or other user focused housing where there's a specific operation that's related to a unique type of user beyond just your traditional multifamily. Then we focus on N of one emerging operator. So it has to be a pedigreed operator that we know is going to be able to scale the company, but they're building something that is N of one in the sense that they are building some technology or they're building some operating overlay or operating brand that is paired with the real estate that's going to allow them to outperform and build a moat for them in the market as they scale. Lastly, the scalable operating company, having something that we can, take a small piece of, that third layer of the cake, that is going to scale over, an 8 to 10 year period of time and hopefully exit so that, and again, this is the more venture piece of the investment, is not just taking, our equity in the property itself, but also in a scalable operating company. So let's walk through this in an example deal. So let's start with traditional multifamily. So we've got Green Hills Capital here, and they're buying your standard kind of small to mid-sized multifamily building in an urban city. And here's our heroes, Brad and Paul, who are going to come in and invest in this deal. So the deal requires $10 million of total equity. There's a $3 million investment that's going to come from Brad and Paul. And generally speaking, it's going to perform relatively well. And we're going to get a 15% IRR over a 5-year period. That looks like a $3 million profit to us. And that's 2 times multiple uninvested capitals. Great outcome, downside protection of the real estate. We knew our money was never going to zero. It performed relatively well. We doubled our money in 5 years. That's kind of your standard down the fairway value add real estate or multifamily investment. Now let's look at what venture-esque extended stay looks like. So we're going to take the exact same asset that's owned by Green Hill Capital or Green Hills Capital, but they are going to layer on a new operating company that they're starting called Flex House. And Flex House is going to come in and they're going to operate these units as corporate stay or housing for, a traveling nurse community. But basically they're furnishing the units and then they are, renting them on 1-month terms rather than 1-year terms. And, they are going to have a brand that's going to attract consumers or contract with enterprise contracts. And so this is how they're going to generate, higher yield on the asset. So again, our heroes, Brad and Paul, are going to come in and invest in the deal. It's $10 million total equity. They're going to come in with a $3 million LP investment. So really no different than the other deal. But now, there's going to be 3 layers here. So the first is going to be the LP return layer. Because we are layering on this operational piece to it, we're going to generate a higher IRR, call that 25% over a 5-year period. So we are generating a $6 million profit rather than a $3 million profit. That looks like a 3 times multiple on invested capital. So versus our original deal where we got 2 times our money in 5 years, in this case, same asset, but we're investing in a more niche strategy. That's getting us to 3 times our investment. Now let's hold that for a second and let's look at the second layer here, which is taking a percentage of GP economics. So because we invested early and we invested significantly in that first deal, we also took a small piece of the GP. Let's say we took 20%. So the GP's fees off of this, so that's, asset management fees for managing the $10 million that they raised alongside, development fees and or, acquisition fees or leasing fees. It all added up over 5 years to $1.5 million. And then they got their promote. Again, they outperformed, they hit a 25% IRR. So their promote is meaningful. It's $3.5 million, total of $5 million in fees and promote to the GP. Remember, we own a piece of that. We've got 20%. So we take $1 million as the second layer. So now we went from $6 million profit to a $7 million profit and a 3.3x multiple on invested capital rather than 3. So now we've hit our second layer. Now let's table that and let's look at our third layer, which is going to be that OpCo equity piece. Because remember, remember, we got a piece of Flex House. And so in this scenario, let's say what happened with Flex House is not dissimilar from what happens with, a lot of different hotel brands. Look at Marriott, who started out as a hotel investment company. They built a brand to operate it. Then they spun that brand out. Now I think Marriott's are owned, like 3% of Marriott's are owned by Marriott. And so, we are able to Green Hills similarly grows Flex House. They're not turning it into Marriott, but, they hit an OpCo EBITDA at year 8 of, $20 million, which means, they're probably in like 50-ish properties. So their exit multiple on a relatively high growth brand in the multifamily or residential space can go for, anywhere from 6 to 10x. So let's call it 8x. And let's say they exit for $160 million. And let's say Marriott buys them. So our 5% piece now that we own is worth $8 million. So now we're at a $15 million profit after 8 years, which is a 6 times multiple on invested capital. That original deal that we did that was going to be a 2 times multiple, we now looked at a 6 times multiple. We 6 times our money on this deal, and our heroes, Brad and Paul, are really happy. And this can continue to go up. So, the OpCo piece, that's really the venture bet, like I said, that you're making. So, in this scenario, we see, the OpCo EBITDA double. So maybe they go from 50 to 100 buildings, or they get into bigger buildings and bigger contracts, and they end up with $40 million in EBITDA, same exit multiple, but now they exit for $320 million. Our 5% piece is worth 16. Now we've got a $23 million profit on this deal and a 9x multiple, and that can continue to go up if the operating company happens to hit a home run. But the important thing here is that there's downside protection the whole time. Yes, we went from 2x to 3x to 3.3x to 6x to 7x, but the whole time we had our money protected, unlike a venture investment. So, let's say in a scenario where, this extended stay strategy doesn't work. There's a stroke of pen, event in New York where this building is, and we can no longer do extended stay or corporate housing in this zone. So Flex House basically goes away. So now what are we left with? We are not left with a zero. We are left with a relatively, well-performing multifamily building. It's a multifamily asset, still well located. It will rent on market terms and hopefully generate a 10 to 15% IRR. So that's what we're so excited about with this type of investing, is really the asymmetry. It's the downside protection of traditional real estate with the upside that is more venture-like when you're able to get a piece of GP economics and a piece of an operating company or a platform alongside your LP investment.